Hello everyone, I'm John Cunnison. I'm the Chief Investment Officer here at Baker Boyer, and welcome to our monthly market update. Today I'm going to be talking a little bit about the economy and where we are from things that are going our way, things that we continue to watch, and we're going to talk a little bit about markets and how are markets pricing these things. What should we be thinking about in terms of our investments? And of course, we came into this year and there was geopolitical conflict, right? We're no strangers to geopolitical conflict. This has happened, markets have dealt with this over time, but it did create some inflationary pressure. So we did see oil prices push higher with, all the concerns about supply constraints out of the Strait of Hormuz. But right now, what we've begun to see is some de-escalation, talk of de-escalation. There's good reasons to believe that will continue, particularly with an election looming in the future. And the U.S. has actually weathered this storm pretty well. And in part, that's because we've become a net energy exporter. Right? Our country, our economic growth is less dependent on inexpensive oil. But still, for households, this is an important issue, and it's if we do see some de-escalation and some easing of oil prices, I think we're very likely to see that provide some relief to families, which can contribute to household spending. The other issue I think that has been really important, particularly when we look at economic growth, is immigration. And we've talked about this in this setting many times, but there's really two ways for an economy to produce more things, right? To generate more growth. One of those things is to have more workers, more people doing the work that generates the things that we all buy, whether it's goods or services. Now, immigration policy has been very restrictive. So we have fewer people, fewer growth in the number of workers. Now, that's been offset in large part by gains in technology, which have led to productivity growth, right? So there's two ways, right? More workers or more output per worker, right? That's productivity growth. We're seeing more of that. We're seeing that begin to push higher. So even though we have these demographic and immigration policy headwinds as far as the number of workers, we really have some tech tailwinds, right? Some technology tailwinds. Now, this chart that I'm going to be showing here on the screen, if you look at the right side of this chart, each of those bars represents economic growth during that decade. Now, the composition of that growth in blue, the blue part is growth in the number of workers. And the gray is the growth in the output per worker. That's productivity, right? So those two things show us the growth in real output. And historically, what you've seen is that it's tended to be fairly balanced, right? You've growth in workers, sometimes it's productivity. Looking forward, I think there are a lot of reasons to believe, particularly with the constraints around immigration, I think it's highly likely that most of our real economic growth is going to come from productivity. The good news there is that there's enormous investments going into things like AI that have the promise of enhancing productivity. And we are actually seeing that in the data, which is encouraging. With all of that, we do expect economic growth to slow somewhat. And there's several reasons for this. Now, even though it's slowing, we don't expect it to go into reverse. Business investment, consumer spending, government outlays, those have all been relatively strong. Where we've seen some kind of negative contributors to growth have been in residential investment and net exports, right? Basically meaning we're still importing more than we export. And those have been a drag on economic growth. The other thing would be fiscal stimulus. So there was every expectation that there was going to be, particularly with tax cuts under the current administration, a fiscal stimulus at the beginning of this year. And while there was some of that, much of it was offset by higher prices, right, by inflation. So As we begin to see oil prices moderate, we begin to see that, and if the election, if we see a change in the House from Republicans to Democrats, we've got a mixed Congress, it's very likely that we're going to be seeing some constraints on unfunded government spending or tax cuts because there'll be more gridlock. So that would likely be a headwind to growth as we see government spending as less of a tailwind. Now, the labor market today is very interesting. Now, I say that because it's quite strong, and surprisingly so. Going into this year, I think most economists expected that we would see fewer growth in jobs. What we saw was actually quite strong job growth, particularly in the second quarter of this year. But going forward, I think the expectation is that we'll be seeing something like 50 to 70,000 net new jobs per month that are created by this economy. But there's really, in some ways, two forces that are acting to suppress job growth at levels that are a little lower than we've seen historically. One of those factors is a smaller pool of available workers. We've talked about immigration policy, but also demographics. The other thing is productivity. So we're looking at very solid productivity growth for firms. So it's highly likely that many firms are going to be able to meet demand with fewer workers. So it's very likely that we'll see less job growth. Now, what's interesting is in normal times, if we see less job growth, we see higher unemployment. But of course, we have this relatively constrained pool of labor supply for various reasons. So while the job market isn't particularly strong, it remains tight. That is, unemployment remains relatively low, and I think we expect that that'll continue. Sometimes that can contribute to inflation. If you have fewer workers and these firms are competing for those workers, it can drive wages up, right? And that's what we call cost push inflation, right? So the costs go up for companies, they have to raise prices. But I think it's unlikely that we'll see that. Right now, with levels of uncertainty relatively high, it's unlikely that businesses are going to be wanting to adjust pay significantly. And right now, that uncertainty also causes workers to be hesitant to ask for wage increases. So we expect the labor market to continue to be, reasonably strong and fairly tight. Inflation is a really important topic right now. I know many of us are concerned about it. Many economists right now, I know, predict that May was the high point that we're going to see for inflation. Now, there's a lot of risk to that prediction. But, I know I'm thinking specifically of economists at JP Morgan. And recently they predicted that we'd see about 3.3% CPI inflation by the end of the year. And by May of next year, so this time next year, something closer to 1.8%. Now that, of course, is in line with the Federal Reserve's target for inflation. And there's several reasons that are contributing to that. One is that we do expect that if we continue to see easing in the Middle East, you see oil prices come down. But the other thing is that demand for housing, demand for rental properties, particularly with constraints around immigration, the demand is easing. And so we should be seeing residential, particularly rent growth, prices slowing. So we should see some cooling in inflation. Now, what does that mean for the Federal Reserve? And of course, this is really important for all of us. It's important for markets. And increasingly, as we entered the year, most people thought that we'd see a Federal Reserve that was cutting interest rates. But of course, we saw this surge in inflation. We still have a relatively tight labor market. That has caused many people to flip that expectation. So instead of anticipating cuts by the end of the year, they're anticipating as many as 2 hikes by the end of the year. And this was a couple of months ago. Since then, things have shifted again. We're beginning to see some easing in inflation. So I think many economists are predicting that the Fed will stay on hold, right? No increase in rates, no decrease in rates. And that's I think a forecast that's beginning to get absorbed into markets. So let's take a look at markets. And here, briefly, just talking about bond markets. The bond markets right now look fairly priced, right? And here's a chart that I'm putting up on the screen now. And this chart simply shows, over the decades, so each of the different colored dots represents bond markets in that decade. And on the x-axis, so the horizontal axis, you see the starting yield, right, of that time period. And then you see on the left-hand axis, you see what the resulting return was, right? And it makes sense, but there's a very close relationship between the starting yield on a bond and what the total return was to that bond. And that makes sense, and that's why this line goes up and to the right. Higher yields mean higher total returns. What do we expect with what we're seeing right now with starting yields? Well, starting yields are right in the neighborhood of, for the broad bond market, 4.7%, right? And there's an arrow pointing to that spot on the chart, and that corresponds to approximately a 4.7% return on these bonds. So right now, I think we would say we're fairly neutral in the bond market. We don't think that there's any reason to sort of overload your bond allocation or underweight it. A neutral allocation is what we're anticipating, targeting. Looking at the stock market, we continue to see large cap US stocks, particularly tech stocks, looking relatively expensive and looking over concentrated. Their tremendous returns that they've experienced have caused their weight in many of the indexes to grow. So you may have a fund that's an S&P 500 fund, and you think you're well diversified. You've got 500 American companies. And while that may be true, the sheer size of the largest, now, when we look at those 500 companies, something like 30 to 40% of that index is made up by the top 10 companies. So while it used to provide broad diversification, now it's more concentrated, and there are risks with that. Now, there's some encouraging signs that the rally that we saw in the beginning of the year with many of these stocks, that rally is beginning to broaden out. Right? So now we're beginning to see even small cap stocks, for example, value stocks, begin to outperform some of the largest US companies. And of course, Baker Boyer portfolios are well positioned for that. But I think the key here is thinking in terms of diversification, thinking in terms of seeking returns in other areas of the market, as there is a risk in concentration. Now, the final thought that I have on markets is just around international stocks. Now, you've heard me talk at length about international stocks. Of course, returns to international stocks, for those who kind of stuck with us, had a meaningful allocation to them, those returns have been fabulous. They've been really good. And generally speaking, both in 2025 and 2026, international stocks have outperformed US stocks. Both returns have been excellent, but they've outperformed. Now, we anticipate that could continue, right? And there's three reasons for that. One is non-US stocks are still meaningfully less expensive than US stocks, even after this great run and performance that we've seen. Second is that the dollar is still, on a trade-weighted basis, relatively overvalued. We could see a weakening dollar. When we see a weakening dollar, in almost all cases, that's a tailwind to international stocks. And then finally, there are many US investors who are underallocated to international markets. I don't think that includes Baker Boyer clients, but as you begin to see investors begin to shift their investments from the US to international markets, that alone can drive international returns. So we think it's important to maintain a meaningful allocation there. So that's a lot over the economy and the markets. If any of you have any questions for me or any of the Baker Boyer team on anything we've discussed on the video today, please reach out to us. We're always happy to help. And with that, take care and good investing.